You can be the best poker player in the world, but if you have poor bankroll management, you're just always going to be broke. You have to be able to have the right bankroll management. And that's part of being a professional poker player. It's very, very similar when it comes to investing. You can be the best stock picker in the world, but your returns can be abysmal because you're speculating too much on the wrong name, or you're sizing things incorrectly, or you just don't really understand how to size, when to add, when to trim, when to have dry powder in the portfolio, when to have cash, when to be fully invested, and when to be a bit more defensive. And all those things are massive drivers of return.
Before we dive into the video, if you've been enjoying the show, be sure to click the subscribe button below so you never miss an episode. It's a free and easy way to support us, and we'd really appreciate it. Thank you so much. So I've been really enjoying diving into your research in recent months, and I've just been eager to bring you on the show here to discuss a few different themes. And being a host of this show, I've looked at and reviewed the investment track record of several investors, and when I saw the track record that your team publishes, I was quite impressed, to say the least. Since January of 2017, you guys achieved a net return of 27.1% versus 14.7% for the S&P 500. So really looking forward to hopefully learning a thing or two from you here today. Before we get into some of the themes we're going to discuss, how about you just talk a little bit about your approach to markets and how you guys take a differentiated view to investing?
Yeah, I think there's a few things there, and I go on for a while. So if I get long-winded, please feel free to cut me off, ask some questions. But to simplify things down, we really look for two things. We look for, so obviously, stock investors, we're investing only in public equities. And we look for companies where their future state is going to be brighter than their current state. So it's all about the future relative to the current state. We believe investing is about predictions. It's about anticipating the future. I don't think it does anybody any good to just try to get an understanding of the present and the current state without having some reason to try to conceptualize what that business is going to look like going forward. So that's the first criteria: the future state better than the current state. And I'll get into what we mean by better. And the second pillar is that your view of what that company is going to look like in the future has to be variant than the broader market. It doesn't necessarily have to be contrarian. It can just be variant. Whether it's, hey, I think this company doesn't look that great today and it's going to look slightly better tomorrow. Or I think this is a great company and everybody thinks it's a great company, but I think it's going to be a generational company and nobody really quite has a similar perspective as I do. So that's what we kind of qualify as variant. And really the key, when my brother and I, my business partner, when we're talking about companies, and the terminology we use to get our focus in the right place is we tell ourselves all the time, we will say this to each other all the time, is the motor of the business strengthening? And when you say motor, like, people automatically think of something under the hood. That's actually the true driver of motion. And that's, it's the same intuition when it comes to businesses. Is that motor actually strengthening? Is what's driving that value to customers, what's driving their ability to gain future customers, is that getting better, regardless of what the actual financials look like currently? So it's not about the current financials, it's about the health of what's generating the financials. And what the financials look like and what the actual key, the motor of the company, what's actually kind of building up that potential energy, so to speak, those two things can be divergent for quite a period of time. So, and we can get a plenty examples why a business might be strengthening, the motor strengthening in the speak we use, but the financials may not look great for whatever reason. So those are, and we don't look at traditional metrics of quality like anybody else, and we can get into our take on extrapolation, mean reversion, and so on, and our critiques on that. But hopefully just that gives you a general idea.
Yeah, I want to tap into just as investors, we're in the business of making predictions, whether we know it or not, right? And, you've recently talked about how some investors can fall prey to just, taking recent financial results and data and extrapolating the past into the future. And, I thought that, you have this interesting perspective where you're really taking a fundamental approach of analyzing the current state of the business and seeing where that's going into the future and not letting maybe the recent past play too much into that. And, some investors, I think, can go as far to, simply extrapolating stock returns, right? And unknowingly chasing momentum. And I think it's a good reminder that we as humans just naturally are looking for patterns, right? And that can sometimes and oftentimes work against us in investing. So how about you just talk a little bit about how investors are in the business of making predictions and how useful past data is in making predictions for the future?
Yes, if you agree, like we do, like you just said, that investing is about prediction of sorts, then you have to ask yourself, okay, then what data do I look at that actually has signal? And you had mentioned stock returns, and stock returns actually, it is well documented, do exhibit a momentum effect. So actually, from my perspective, it makes a lot more sense to try to extrapolate just based on stock returns than it does based on financials. If you look at financials, and the data is clear on this, they do not exhibit momentum effect. So if you just take a look at all, like data mine right now, look at all companies that have grown their revenue or earnings or whatever fundamentals you want to look at, that have grown the revenue by 5% over the last 5 years. And then you try to say that, is there a correlation between how they grew revenue over the last 5 years versus the next 5 years? And the correlation of that is very, very low. So that was a big epiphany for us as investors, because I think investors, and it's almost everybody I talk to, it's like, hey, they grew earnings at X amount over the past 5 years, or they grew revenue at this, and their PEG ratio is whatever it is. And I think it's a good stock because of X, Y, Z reasons. But the foundation to their thesis is that, hey, because they grew earnings, that it's reasonable to assume that they'll continue to grow earnings in the future or continue to grow revenue in the future. And it's just not, if you look at the data, it's just not true. The correlation is very, very low. So once you realize that there's no real pattern in past financials for a business that is a good predictor of future financials, then it's like, okay, well, why are past financials useful to look at? Why are the trends in past financials useful to look at? And I think that for us, it's useful, but just in terms of building context, like, okay, well, what happened when revenue did this, and management, how did they respond? Looking at financial trends can give you an idea of where a company is in its life cycle. And this can kind of help you build context. Once you bolt on many other ideas and understandings, can give you a basis for prediction of what the business will look like. The takeaway is this: financial trends themselves should never serve as a sole basis for prediction in what the trends will do in the future. And I think that it's not that intuitive for investors to think that way. I guarantee most investors you talk to are going to look at your chart and assume that the trends will continue. But for all types of reasons, like maybe the company's riding at a trend that's coming to an end, or maybe they overhired salespeople and overhired or overspent marketing efforts, and marketing expenses are going to change in the future. And as a result of that, they've seen improving fundamentals. Maybe it's a company or like a platform company that's raised its take rate a little too high. Just continue to bump it up slowly, aggressively. And it's kind of reaching a plateau. And that over monetization is long in the tooth. Or maybe it's a company that's just mortgages future in some respect. I mean, there's an infinite number of ways why historical business performance may not continue. So that was really a big epiphany for us, is realizing there's no correlation. Okay, if there's no correlation, then what do we do to try to build our prediction and that conceptualization of that company's future?
Mm-hmm. And I was reading your research this morning, and one of the points I also wanted to bring up was that you mentioned that effective portfolio management is more critical than just being good at picking individual stocks, which is actually something you started to pick up during your time playing poker, during your college years and time in the Air Force. How about you talk about some of the things you've learned with regards to effective portfolio management? Because I think that has to be a key driver in the alpha you've generated today, other than simply selecting good stocks.
Yes, I think portfolio man, you said it perfectly. I think like from my poker days, you can be the best poker player in the world. And in poker, they call it bankroll management, not portfolio management. But you can be the best poker player in the world, but if you have poor bankroll management, you're just always going to be broke. You have to be able to have the right bankroll management. And that's part of being a professional poker player. It's very, very similar when it comes to investing. You can be the best stock picker in the world, but your returns can be abysmal because you're speculating too much on the wrong name, or you're sizing things incorrectly, or you just don't really understand how to size, when to add, when to trim, when to have dry powder in the portfolio, when to have cash, when to be fully invested, and when to be a bit more defensive. And all those things are massive drivers of return. And especially if you look at you just deconstruct your portfolio returns contribution wise and see, okay, where my returns came from. And, there'll often there's a bit of a power law there. There'll be a few names that kind of really help things along. We tend to have somewhat higher turnover in our portfolio. We tend to run a concentrated strategy where we have our core positions, which will be weighted around 5 to 15%. Then we have our starter positions, which are positions which we would like to make it core, but we just maybe speed is more of the essence there than deep dive research. And sometimes we kind of just have to take a position when you're in the fourth inning of research. So these are names where they have the potential to graduate into a larger position. And then we have speculative positions where their downside is more severe, but they have significant upside potential. And anytime a name, and Kelly criterion, which is one of the tools that gamblers use, is very, very, I think, very, very relevant when it comes to portfolio management. And what the Kelly criterion tells you is anytime you have a situation where there's 100% downside, you should probably size smaller, no matter what the upside is. Where I'm not sure if that's very intuitive to investors. Investors typically look at the upside and like, oh my God, this thing whatever, go up 1,000%. Let me try to load up in this position, when it's the exact opposite mentality that you should use. It's like, no matter what the upside is, if the downside is severe, then you should size down. And I think just that key is just instrumental to anybody's ability to manage a portfolio. And there's also, since we run a concentrated strategy, our portfolio methodology is going to be a little different than somebody who has like maybe 100 different positions. I think averaging up becomes a lot more important in that kind of strategy, where for us, initial sizing is extraordinarily important, where maybe it's not really that important for somebody who takes kind of an equal weighted 100 names or something in their portfolio. So I think there's a lot to portfolio management. There's a lot in the curriculum that I think is very misleading with respect to modern portfolio theory and mean variance optimization. I think that stuff is kind of useful to maybe understand a little bit on an intellectual level. But at the end of the day, you really have to understand exactly what risk means in your portfolio. It's not volatility. It's something else, and try to structure your own portfolio management strategy.
Yeah. And one of the things that I see in your approach, you're very value driven, I think, fundamentally, even though you might not give yourself that label necessarily. In some cases, you're admire Buffett and Munger. But, you hear a lot of value investors say the same things, say they think independently and whatnot. And then a lot of them just hold a lot of the same stocks. And then I look at your portfolio and I'm just like, I really think this guy does think independently, because I've seen, these are a lot of names that I have not seen before. So I think there's something really here. And one of the things that I haven't heard you talk extensively about how you view cash, but it sure seems to me that, your team is really willing to let cash build up, at certain points, and being really opportunistic in entering some positions. And I think it's easy to say that, markets go up every year. You should likely hold very little cash. But then there's also the case where at times there's these very extreme dislocations. And if you don't have cash, then how do you, allocate to those positions? So talk a little bit about how you view cash in a portfolio and, in this discussion of portfolio management.
Okay. Yeah. I think there's few things as terrible from a portfolio management perspective as there being opportunities out there in the marketplace and you not having the cash in order to take advantage of them. So, and we never want to be in a position where we have to sell a position. It's in the portfolio because we like it. We don't want to be in a position to have to sell it to buy something else that we like more. We think that makes, the calculus more complex than it needs to. So we tend to have cash. We idle at around 15% cash. And at the end of the day, the prevailing wisdom is that cash is a drag on performance because, as you said, markets kind of, they go up over time. So the other side of that is that if you don't have cash, you can't take advantage of opportunities when they present themselves. So that's also an opportunity cost that I think gets lost. So we never want to be in a situation where markets are a little fragile. There tends to be enormous volatility at individual stock levels. A stock that we think is quite interesting sells off with extreme rapidity for whatever reason. We don't have cash. So being able to tactically deploy that cash very aggressively, which I think has to be part of your repertoire if you are somebody that does carry cash. You don't want to be in a situation where it's structural. It's like, oh, okay, well, they have maybe 30% cash on Tuesday, then Friday something happens and now they're at 5% cash. That's how we think about cash. It's very aggressive or very defensive. So I think it's an amplifier of returns, or at least the way that we've used it. I think it's lost on investors that it can, there's an opportunity cost, but the opportunity cost cuts both ways.
Mm-hmm. And one topic I haven't discussed in depth on the show is working capital. I feel that working capital is something, it's easy to overlook because it's sort of happening behind the scenes. How about you talk a little bit about the importance of working capital from an investor's perspective?
Yeah, I think working capital is one of those things. There's the accounting definition of working capital, current assets minus current liabilities. That's not really what is relevant. You have to strip out non-operating accounts from there. So if, when we're talking about a working capital for business, we're talking about it intuitively. We don't care about, current debt or, cash or cash equivalents. That's not, unless you're a finance company, you need cash or cash equivalents to support revenue. But when we're talking about it, it's purely the amount of money in a business that needs to be tied up to support a unit of revenue. So, and it's going to be different for different businesses. So maybe in some businesses, you need customer service agents to support revenue. Without them, you will lose revenue. So that should be part of your working capital. So for us, it's really, really important, I think, working capital. I think especially depending on the life cycle of the business. And if you're somebody who looks at small cap names often, working capital is especially relevant when you have a smaller cap name that's trying to grow. Because when a small cap name is trying to grow, cash is like oxygen. It's not like these larger companies that have many levers to pull and they can finance things in all sorts of ways. You want to have confidence that they can maybe or probably finance their growth internally. And a big part of that is if they have negative net working capital. So if they have, if their customers are paying them ahead of time, or they have really good terms with their suppliers, or maybe that those metrics particularly aren't great, but they're getting better, then they're going to have a little bit more liquidity to help them grow. On the other side of that, you can have a company, and this happened during COVID, where a company needs inventory as part of their working capital to support their revenue. And when supply chains are very, very efficient, they can have just-in-time inventory. They don't need that much inventory to support a unit of revenue growth. But once things get a little murkier or geopolitically things get fractured, they're going to need more days on hand of inventory, which is a drag on free cash flow because they need more cash to support a unit of revenue. And if that never gets fixed, or if that never becomes more efficient, then that's going to decrease from your future free cash flow. Obviously, everybody here agrees that the value of any business is its future cash discounted at present value. And it's that cash is no longer free to discount to present value. So you need to take a discount on that. So it's just, I think it's very, very useful, especially when dealing with small names, or when dealing with structural changes in inventory or relationships with suppliers and so on. So it's something we spend a lot of time looking at smaller names, because there tends to be more, just incidentally, there's more smaller cap names than they are larger cap names, where we're generally always trying to be focused on a company growing. So their liquidity and how they're able to finance that growth is exceedingly important.
Yeah, there's a couple interesting things about working capital that I can highlight here. I think one is that it can sort of help highlight the strength of a company's moat. So you mentioned, the suppliers being paid after the inventory is received, then, that's like a business like Costco, right? They're largely being financed by their suppliers because they receive inventory far in advance of needing to pay suppliers. And that sort of illustrates how the suppliers need Costco more than Costco needs the suppliers. And then the other point is, you guys highlighted something that Joel Greenblatt said, where, if you compare a company like Coca-Cola to a company like Moody's, Moody's can largely grow revenue without having increased working capital needs, whereas Coca-Cola, as they grow, they have increasing working capital needs with every incremental dollar of revenue. So with that said, does high working capital needs ever keep you from investing in a company?
Jim Rohn once said that you're the average of the 5 people you spend the most time with, and I really could not agree with him more. And one of my favorite things about being a host of this show is having the opportunity to connect with high quality, like-minded people in the value investing community. Each year, we host live, in-person events in Omaha and New York City for our TIP Mastermind community, giving our members that exact opportunity. Back in May during the Berkshire weekend, we gathered for a couple of dinners and social hours and also hosted a bus tour to give our members the full Omaha experience. And in the second weekend of October 2025, we'll be getting together in New York City for 2 dinners and socials, as well as exploring the city and gathering at the Vanderbilt One Observatory. Our mastermind community has around 120 members, and we're capping the group at 150, and many of these members are entrepreneurs, private investors, or investment professionals. And like myself, they're eager to connect with kindred spirits. It's an excellent opportunity to connect with like-minded people on a deeper level. So if you'd like to check out what the community has to offer and meet with around 30 or 40 of us in New York City in October, be sure to head to theinvestorspodcast.com/mastermind to apply to join the community. That's theinvestorspodcast.com/mastermind, or simply click the link in the description below. If you enjoy excellent breakdowns on individual stocks, then you need to check out the Intrinsic Value podcast hosted by Sean O'Malley and Daniel Monka. Each week, Sean and Daniel do in-depth analysis on a company's business model and competitive advantages, and in real time, they build out the intrinsic value portfolio for you to follow along as they search for value in the market. So far, they've done analysis on great businesses like John Deere, Ulta Beauty, AutoZone, and Airbnb, and I recommend starting with the episode on Nintendo, the global powerhouse in gaming. It's rare to find a show that consistently publishes high-quality, comprehensive deep dives that cover all of the aspects of a business from an investment perspective. Go follow the Intrinsic Value podcast on your favorite podcasting app and discover the next stock to add to your portfolio or watch list.
It's not necessarily they would be high working capital needs. And in Coke's situation, obviously high working capital needs is not indicative that they have a lower moat or anything. It's just the nature of that business. So you have to take a nuanced view. And I think that with it's more about how the working capital is changing. So if for whatever reason they have to pay their suppliers sooner, or their customers are starting to pay them later, that's something that should raise an eyebrow, and you should be asking a lot of questions as to why that's the case. So for us, it's just something to be cognizant of. And if it starts changing, it can absolutely affect whether or not you invest in it. Like we just looked at a trash, I'm not going to name the ticker, but it seemed like their DSOs were increasing. Their customers are taking longer to pay them, and they didn't really release customer concentration information. And this is a smaller company where they essentially roll up waste haulers. So any business that needs that creates waste, that needs that waste taken to a landfill or a compost facility, this business, this trash company would assist them in their needs there. It was just taking longer for their customers to pay them. They had accumulated debt because they're rolling up these other waste haulers, and it just didn't seem like it seemed like they were going to run into liquidity issues, kind of where they're headed. This was a company that if we had seen their terms with customers start to get better, maybe it's possible that we could take a position. But there's just too many headwinds along with their the debt they have to service and not being able to have that liquidity buffer from negative working capital.
Mm-hmm. So one theme I wanted to discuss today is digital payments. So this is an industry I've personally tended to avoid. One reason being that there just seems to be so many payments companies out there, and just it was difficult for me to understand where the moat was for some of these names. So wanted to be sure to touch on this theme and maybe one or two companies as well. How about just broadly, what makes the theme of digital payments interesting to you as an investor?
So I like the idea of, and just part of our overall strategy, we like to see the just tailwinds for a certain business. And it's better when the tailwinds aren't entirely obvious. But our most ideal situation is we find a business that's a share gainer and there's certain tailwinds in place. Well, we would never invest in, although we don't always invest in share gainers. There has to be that external element. We would never invest in a share donor, no matter what the tailwinds look like. But there is exceptions. Obviously, if you're a share taker and the tailwinds look quite favorable, then that's definitely something we're going to look at. Obviously, there's a valuation component in there. So with payments, you have this extraordinary tailwind, which is just M2 growth. Central banks are going to continue to print more and more money. Even in a recession where we see M2 growth fall off, there's a whole lot central banks have learned to do since 2008 to stimulate to print, and that M2 growth is going to just pick back up. And if it doesn't, they'll, just like they did during COVID, they'll just start handing people money. So you can be pretty convicted over just from the historical record that M2 growth is going to continue. So if you have a company that has like a scrape on M2 growth, that's obviously very attractive, given, their take rates can remain stable. And if you find the right kind of payment company, like, if you caught Stripe early, for instance, or Adyen early or something like that, it can be enormously profitable. There's a few payment companies we like, but that's really the broad strokes of it, is that, look, there's going to be more and more money that's out there. And if there's companies levered to just a little bit of that, it can be enormously beneficial, especially since that incremental investment when it comes to a payment company, the cost needed to support extra unit of revenue growth is very, very, very low. So it scales wonderfully and the tailwinds are amazing. So it's one of the reasons why we like payment. Obviously, there's a lot of them. Some of them are decent. Most of them are not. But that's the whole kind of gist about why we find payments interesting.
The other aspect of payments that has made it a bit difficult for me to get comfortable with some of these payment players was the rise of stablecoins. So I was just looking at a couple of stablecoins this morning, and it just seems like the market cap of some of these is just only exponentially growing. So for those not familiar, stablecoins, a cryptocurrency that's pegged to a reserve asset, such as the US dollar, and it allows people to transfer these tokens, we can call them peer-to-peer, without necessarily needing a third party. And part of the issue with stablecoins, I think, though, is that if you're in a developed country, you probably don't want the stablecoin. You want, dollars or your local currency or whatnot. I'd be curious to hear what you're seeing on the stablecoin front.
Yeah, I think stablecoins right now are really the domain of the crypto world. If you look at the usage, it's overwhelmingly people who are buying crypto, and it just facilitates it a lot easier on exchanges. Being able to hold your money in stablecoin and then trading crypto and then going back on a stablecoin and so on. And the U.S. government, I think, is through the Genius Act is going a long way to regulating those reserves to give investors confidence in something like a Circle that those reserves are intact. And obviously that benefits the U.S. government because it creates a sustained demand for treasuries, which those reserves are placed in. So it's in the interest of the government to provide this type of regulatory framework. But if you look at the data, there's limited use of stablecoins in the real economy. It really hasn't happened at all yet. There's some situations in some frontier markets where just the banking system is totally ruptured and people are using stablecoins to pay each other. There's a few countries in Africa like that. But other than that, there really hasn't been any penetration at all. I'm not saying there's not going to be, but the market seems to think that remittances are going to be the first to be affected. Remittances being people sending money to others, typically and when I say remittances, I'm talking about cross-border remittances because they tend to be more expensive, so more easily disruptible. But that hasn't happened at all yet. And I personally think that you're going to see stablecoins as an alternative payment method first before you see it in remittances, primarily because the cost of remittances have come down significantly. And as long as people are continuing to use fiat in their local economy, it's hard for me to suspect, given the cost of remittances, that people are going to start using other methods to send money to, friends and family or whatnot. So until their friends and family start using maybe stablecoins to pay for things in their local economy, we believe that traditional remittance providers are still going to be completely relevant, just as they were in the past. And those are the services that are going to be used to transfer money. So we don't think the remittances will be the first to be affected. We think just payment methods will, and it'll start to show up as an alternative payment method. Much like you can go in and kind of use Venmo to pay for something at your Walmart or your CVS or something like that. You're going to see that, oh, okay, maybe I can use my stablecoin to pay for something. And then I think that's where it'll start. And once that penetration starts to happen, then we can start to talk about maybe how it's going to impact remittances. But I think we're a very, very long way off. And if you look at just how sticky payment methods tend to be, like historically, payment methods, even if they're not exactly optimal, tend to stay intact for a very, very long time. So it tends to require quite a sense of urgency for people to switch to a new payment method. So I just don't see that changing anytime soon when it comes to payments or remittances. I think it's going to stay in the crypto space for a considerable amount of time.
Since you mentioned remittances, let's dive into Remitly, which is a shared gainer in the remittances space. So remittances is just whether people might not know this, but it's a massive market. So the World Bank estimates that just over $800 billion in remittances are sent per year. And this brings us to discuss Remitly. I've been learning about this company through some of your write-ups, and then my co-hosts, Sean O'Malley and Daniel Monka, also did an episode on this company on the Intrinsic Value podcast for those interested in learning more. How about we start with what makes Remitly well-positioned to capitalize on this big growing market?
Yeah, so I think regarding tailwinds and trends and why remittances continue to increase, and the number's closer to $1 trillion now, why the number continues to increase. If you look at just demographics, I know there's the political climate is quite charged. There's been a rise in nationalism, and as far as immigration tends to be a topic on the top of every politician's list and trying to, quote unquote, limit immigration. But if you look at median ages for a lot of the developed economy, Japan, Italy, Germany. Germany, the median age is 46. Italy is closer to 48, 49. And even the US is 39. It's not exactly young economies. And the fertility rate, other than the US and most of the economies that I mentioned, are significantly below the replacement rate. So once you have that dynamic, the only way to stop a population decline is through immigration. That there is no other way. So unless you're saying that developed economies are going to let their kind of whole demographics go upside down and have all sorts of issues supporting retirees, immigration is going to continue in mass. And that's why you're seeing global remittances continue to grow by 5-6% every year. And it's now outstripped foreign direct investment when it comes to emerging markets. So that is a mega trend that is going to continue to persist. And, it's something that we really like, obviously, when looking at businesses that operate within that ecosystem. And Remitly has the best-in-class digital solution. And their ability to, I think, to compete with legacy players and their focus purely on the remittance space, I think it just gives them an edge when you look at the other players involved in the space that are pure remittance providers, like, a MoneyGram, a Western Union, a RIA, and even some of the regional players. And there's, Wise that kind of is in that space a little bit, but not exactly. It just stacks up. Their product is solely optimized for remittances, and it's digitally native compared to a lot of the legacy competition that is still sending cash, and that cash is starting to, that's another trend where a lot of the remittances, the cross-border remittances being sent are cash to cash. So you still have, over 100 billion or so that Western Union MoneyGram sends that's in cash, and that cash is going digital, and Remitly is going to be another beneficiary there. So there's a couple trends that we really, really like. They have the best digital solution. It's totally optimized towards migrants. They're doing a lot to build mind share with migrants. Their marketing engine is really second to none. So I just see we don't have many holds in our portfolio that we think are generational holds. And we would hate to say we were ever wedded to a name, but if there's any name in our portfolio that we think we're going to be holding for a very, very long time, it's Remitly. I just think the economics there are going to work really, really well.
Yeah, there's a lot of stuff that I think is really interesting with a name like this. So Remitly's market share looks to be in the low single digits. And as you sort of alluded to earlier, payment solutions tend to be pretty sticky. And I think one of the reasons for that is just trust, right? Once customers get acquainted with a way to send payment, they tend to stick with something that they trust, especially as something as important as remittances. The CEO of Remitly has highlighted this, and I think he understands it. So if someone's making $20,000, $30,000 in the US and they're sending $200 to another country, let's say India, for example, they obviously want to work with a brand that you trust, even if you have to pay maybe a little bit more in fees. That trust is really important because that $200 payment might be what's needed to put food on the table for your family, for example.
Yes, I think just when it comes to financial services in general, like banks, if you agree that banks, it's very important for banks to build trust, then why can't a remittance provider? I mean, it's very much the same. Somebody walks into their bank, they want to feel secure, their money is safe. And it's the same exact thing with a remittance provider. They want to have that trust, and the brand is extraordinarily important. So I think there's a lot of people who will try to say, remittance providers is kind of a commodity or a race to the bottom. But once you have any sort of finance company that's B2C, that trust element is going to be huge. People want to feel secure about their money. So if that brand, if that mind share with that customer, if those emotions are of trust and security, and we're going to do whatever we can, bend over backwards, customer service wise, to make sure that your money gets from point A to point B. Yeah, I think that goes a long way. And it's funny. I know we kind of discussed briefly a bit ago about how I think it's very interesting when there is a business that is more complex than it actually is, and people think that it's a commoditizable business, and that it's not. I think that's a source of error in perception. And I brought up the example of In-N-Out in California, which is a burger chain. And from my perspective, and obviously there's some subjectivity to this, but I know there's a lot of Californians that agree with me. There is almost no other burger chain that has been able to produce a quality burger for as long as In-N-Out has, just bar none. I mean, there's a couple that came up, I think, Habit or Smash Burger or even Shake Shack, but the quality's, it's not been consistent over time. So here's something that should be like the easiest business in the world. It's like, oh, you're producing a burger. But clearly it's a lot more complicated than just a cursory glance would tell you. So, and I don't know anything about the burger business, but I know that it has to be complicated because there hasn't been a competitor to do it as well as they have, not even close. So to me, it's similar with remittance providers where it seems like it'd be easy, but when you look back, you peel back the curtain a little bit, you realize how complex certain quarters can be, the makeup of certain receivers. You obviously have to have a cash distribution network. You have to, maybe disperse money to wallets, or maybe have some sort of way to deliver money through just mobile payment, or through just even on demand, or in the Philippines or you could send money and a courier will go to somebody's house and deliver the money. So like being able to optimize for just the different ways people receive money in these different corridors is quite challenging. Obviously there's the regulatory, the intermediaries you have to have, and licenses and so on. And then there's fraud prevention and, all sorts of KYC stuff that needs to be correct and totally above board at all times. So once you start thinking about all that complexity, it makes you realize that Remitly's focus is very, very special. I think another example that really spells out just how complex it is that PayPal in 2015 and 2016 ended up buying Zoom, XOOM, for about $1 billion. It was part of their foray into remittances. And it was like, okay, Zoom's growing leaps and bounds, and it's going to help us supplant other remittance providers in the space. And what happens after they acquired Zoom is a couple years later, they totally stopped mentioning it. Their growth has been anemic. It's a total nothing burger. They're trying to sell it that they can't. So clearly, if this business is that easy, Zoom would not have been so disastrous of an acquisition for PayPal. But there's something more there, obviously.
Yeah, that's really interesting. What I also find appealing about the Remitly story is you have this legacy player in Western Union, which, based on my understanding, has all these physical locations, whereas Remitly's uniquely well positioned because they're a digitally native product, right? So it's a bit of an innovator's dilemma problem where Western Union has substantial share today, but they're losing share to players like Remitly. So I think it plays well into that dynamic you mentioned earlier, where Remitly's a share gainer and they're benefiting from the growth in the broader remittances market overall.
Yeah, absolutely. You have this giant Western Union. Their payment volume is about it's about 120 billion or so, where Remitly run rates around 80 or so. So you have this giant player in the space that's going to just very steadily continue to cede share. They've had to make an acquisition recently of a regional player just so they can kind of boost their revenue inorganically. But yeah, they're going to continue to cede share, and Remitly is the direct beneficiary. So you have tailwinds, you have a huge player in the space that is just going to be consistently ceding share. You have just a better product. I just think there's a whole host of reasons to be really bullish over the long term. So I have no idea what the stock's going to do in the short term, but yeah, I think the fundamentals and their ability to create just robust revenue growth is going to continue for structural reasons.
So let's see. So we're recording here on August 19th, 2025. And I believe it was last week that Remitly released their quarterly earnings. Just prior to that, you guys added to your position. And one thing that stuck out to me was that you, I guess I should also mention, after the earnings release, the stock jumped something like 15, 20%, something like that, in that ballpark. But one thing that stood out to me in that update you guys shared was that you said the PE was 17. And I'd be curious just to hear you walk through the valuation a little bit. That definitely sounds appealing for a company that's growing 30, 40% a year at the moment. So yeah, how about you just touch on the valuation a little bit, given that this name might be a little difficult for some people just to wrap their arms around.
Yeah, I think that it's trading under 3 times revenue. And I think that it's a company that has really not reach its potential profitability wise. There's so much growth ahead of it that you would almost feel fine if they continue reinvesting and trying to build out growth for the future and so on, which is what they're doing. They're not really pulling the profit lever as much as they can. But even in that situation, yeah, you have a forward PE of close to 20. You have a revenue multiple of under 3x. So I think that from a valuation perspective, if you say that, hey, this company's going to continue to grow revenue for 30% plus over the next several years, yeah, I think it becomes pretty compelling. I don't know given their growth profile, I don't know how many stocks out there are trading at a similar valuation. If you just look at that cohort, I would say they're pretty much going to be top decile as far from a valuation perspective. So, valuation is clearly important. You want to make sure you're not overpaying. And if you're right about the future of Remitly and their growth profile, you're getting it at an extraordinarily attractive valuation day. Yeah, it's really that simple. This asset should be trading at north of 5x sales, and it's trading right around 3. So, yeah, that's kind of how we look at it.
Before we move on to our next theme, I know you follow several companies in the payment space. Are there any others you think that are worth highlighting here? I know Wise is one that's also in your portfolio, and you follow some other names as well.
Yeah, I think Wise is a very interesting company. A lot of people think it's a competitor to Remitly, but they play in a much bigger space. If you look at just payments in general, or just cross-border money movement, remittance is just a small part of that. You have businesses paying businesses, you have banks sending a lot of money. The space is, 50 trillion or so, and then you have remittances that are around a trillion, or other measures cited at 2 or so on. So Wise is not optimized for the migrant remittance TAM. It's optimizing for another TAM that is much bigger, which is businesses sending money, paying overseas suppliers, or neobanks having to send money around that don't want to go through correspondent banking. So it's really focused on a much bigger markets, and that's why its send amounts are so much higher. It's medium send amounts, where Remitly is around 300 or so, and you have Wise that is significantly over 10x that for as far as their median send amount. So they're completely different businesses. And anybody who's used the Wise app and the Remitly app can understand how different they are. Wise almost feels like a neobank compared to the Remitly app. The Remitly app is just remittances. You have a contact center, it's very, very easy to send, totally optimized for that space. But I do think Wise is doing something very interesting. The potential there is quite large. The challenge for Wise is that instead of being more intermediary heavy like Remitly, where Remitly can go anywhere and pretty much just very quickly find the right intermediaries and set up a corridor for people to send, start marketing to people who associate with that corridor and get the ball rolling. Where Wise takes some more heavy lifting with respect to integration into like a country's local rails. You need a certain membership, you need certain licenses to be able to be a remittance player. So they're like, hey, we want to reduce the amount of intermediaries. We don't want any intermediaries. We want to plug into their banking system directly. And then that way we can cut out all sorts of costs and stuff, which I think is great and has worked in some corridors. But getting that regulatory approval is very, very difficult in others. They've already done a whole lot of work, and they've already had a whole lot of integrations. There's just a long way to go, which is also one of the reasons why Remitly sends to maybe, I think, around 170 countries, and Wise is, less than half of that or so as far as the different countries you can send to. That being said, I think Wise is very, very interesting. Wise doesn't have anything to do with the Visa network, where Remitly, their structure is really built on the Visa network. Their migrants send money using their debit card, and where Wise tries to influence you not to use your debit. It's cheaper for them if you use here in the States, we call it ACH and so on. So if like Wise is bad for something like a Visa, because Wise continues to grow, core networks will feel a bit left out, where with Remitly, it's not the same. Anyway, maybe that was a bit technical, but the whole part of it is that Wise is doing heavy lifting to build out like actual piping infrastructure, which I think is very, very useful and can leverage them to a very, very large market if they continue to make progress. So the upside with Wise is quite large. That being said, you do have regulatory obstacles.
So I feel like AI is all a lot of people want to talk about nowadays. It's clear that it's going to be impacting so many industries. And what's interesting about AI now is that, many of us can see and experience, just how fast some of these things are moving, given the progress of ChatGPT and other LLMs. And, you and I can probably see this progress on a weekly or monthly basis, just using it day to day. And I don't think it's common for value investors to become well versed on AI because it's an industry that's just constantly changing, has a lot of capital pouring into it, and it can be difficult to determine who the winners are going to be. Similar to how in the late 90s, people knew that the internet would be huge, but very few people would end up determining who the winners would be. So how about you talk a little bit about why a decent amount of your research has shifted to this area of the market?
Yeah, I think that part of it is existential of sorts. It's affecting so many industries. You want to know how it's going to affect you. Similar to like if you're an employee somewhere, you probably want to start learning about AI and how it might affect things or how it might help you and so on. So part of it is just understanding the gravity of the moment and understanding just how huge of a general purpose technology AI was or is. Excuse me. So it really for us, and this is also true. If you look back, I remember reading some transcripts from like 1999. It was Coca-Cola. It was, what does Coca-Cola know about the internet in 1999? But they were even talking about like, here's how we're going to leverage the internet to improve our marketing efforts and so on. So you can't avoid it. Every company is talking about how it's affecting them or, how they're trying to reposition XYZ or so on. So from our perspective, anytime you have, the latest stat on the hyperscalers is close to $500 billion has been invested in training models and data centers and so on. Anytime you have that level of investment going on, it's kind of important to ask, who might be the beneficiaries there? Are there any companies that are taking advantage of this? And we've had a lot of success with especially smaller companies that have been pivoting towards providing some solutions for some of these bigger data centers, given their energy needs and so on. So I think that you want to know how the world's changing. It's such a massive impact on how everything's changing. You want to try to understand how things are changing, whether or not it has any direct investment implications. It's useful as an investor. You always want to know how your world's changing, and we tend to be more attracted to dynamism. We like it when there's a little bit of complexity or people may not know how things are going to, there's a bit of a fog of war situation. We like to try to analyze to be in that area and do some analysis there. And a lot of times you're not going to be able to gain a full understanding, and that's fine. But I just think that there tends to be more opportunity where there's more dynamism.
So you initiated a position in Meta in March of 2022. You're a bit early in the drawdown, but definitely captured a lot of the upside as you closed your position at the end of July this year, representing over a 300% increase in the stock price over that time period. And, with big tech making up a substantial amount of the S&P 500, many are asking what sort of returns they're going to be getting on this ever increasing spend on data centers. I'd be really curious to hear your take on how these investments could potentially pan out for them going forward.
Yeah, I think that it does seem to be a bit of an arm race at the moment, and I can understand how investors might think there's a lot of capital destruction going on. And I'm sure not every dollar is going to be spent as efficiently. That being said, if you look at maybe Meta is a clear example of this, where you alluded to, in 2022, we took a position and there was all sorts people thought TikTok was going to eat Meta's lunch and Zuckerberg was going crazy investing in VR. And there was that Apple data change that also affected things. So just a confluence of, we think, narratives that promoted just that rapid price decline. But then you can also see that, Meta's response to the competitive TikTok pressures where Reels started to massively increase active users and engagement. And it was clear that, hey, they're responding to whatever the market thinks this threat is. And there's actually you can actually see the progress being made. And with respect to Meta, they're using AI to make their ads better. It's already helped increase their top line. So that's probably out of all the hyperscalers, the most, I think the best example of how that's improved their return on investment, where it's actually helping businesses, just give us the criteria, what kind of ads you want to make. We'll use AI to test, to test 100 different versions and see which one gives you a better return on ad spend. So that's been enormously beneficial for Meta. And for most of these hyperscalers, their revenue per employee has increased dramatically. You just need less developers to produce the amount of work you do. And obviously, they're all training their own models, and it's having an impact already. Whether or not how, something like a Microsoft, how that's going to affect their top line or how that's going to help them increase revenues, I think that remains to be seen. But you're already starting to see massive efficiency improvements for all of them.
Mm-hmm. And when it comes to some of the applications of AI, which ones have you found to be most useful and interesting to dive into and take a look at some of the companies that are developing these new technologies?
I think there's a lot of areas. There's robotics is one that comes to mind. We basically have the hardware for robotics, but we don't have the brain yet. And I think there's rapid progress being made there. If you look at it, it's quite similar to how they trained models to play like chess or Go, where it was basically unsupervised. You give it the rules of the game, and then it just plays itself trillions of times and comes up with these really, I think, unique ideas, or it knows how to play things very, very efficiently. And it's similar to what's happening in robotics right now. They're testing them through simulations. They're using physical sciences to provide just the rules framework around that simulated reality, and they're optimizing for a certain outcome, and then it's running that simulation trillions of times. So I think that brain is coming, and we're going to combine that hardware. That's going to have a massive impact, and it's going to be, I think, a very, very exciting future. And that parallels a little bit to defense. I think there's applications in energy. I think if you look at data centers, at the end of 2025, about 2% of the electricity being used is going to be used by data centers. So that has a lot of questions for the grid and alternate power sources. And there's a lot of companies that are positioning themselves to provide alternate sources of electricity for data centers. And then there's nuclear that hasn't made the headway that I think a lot of hoped, but that might be in the discussion more and more later. So there's a lot happening in energy. It's really, really interesting. Biotech, we haven't dove into quite as much as we'd like to yet, but just the speed of drug discovery and using AI to iterate on, just how different molecules are binding together and just speeding up drug discovery, I think is going to be very, very interesting. So there's so many, I think, applications that, from an investor's perspective, it's just the best time to be alive as an investor. I mean, it's we're very, very fortunate, I think, especially just the changes in all these technologies and how it's going to impact our lives. I'm very, very excited for the future. But yeah, those are just some applications that I think are going to have some serious relevance for all of us in the future.
Yeah, it does certainly seem that robotics is going to be more and more prevalent. Even Amazon is utilizing more and more of that in their fulfillment centers and whatnot. Tesla is making big investments into that, and even have uses outside of manufacturing use case. Are there any companies in your portfolio that play into this theme of researching and better understanding AI?
I think that a company that's using AI to facilitate manufacturing, industrial manufacturing, that's Xometry. And I think the more robotics and these prototypes, these kind of short runs that produce these kind of different types of robots to help facilitate any never-ending human needs, I think Xometry is going to be a huge beneficiary of that, because they provide a platform that enables any sort of manufacturer to submit their CAD designs or whatever the specifications are, and through kind of an AI quoting engine, pick the exact manufacturer to help them to produce these parts. So I think that the more and more robotics are being produced, given that a lot of these robotics are prototype, I think that fits very well in Xometry's hands, which is really a leverage on digital manufacturing. So we're very excited I think about that. And yeah, that would be one I think that stands out in our portfolio.
Mm-hmm. I have one more fun question before I give you the handoff and close it out here. What is something that you think AI will be able to do in 10 years that would be totally crazy if we saw it today?
I think the real breakthrough in AI would be if it helps us solve something that we scientifically that we couldn't solve, or a huge breakthrough in healthcare. For it helps us cure something in healthcare that we didn't think was curable. So, I mean, really, if you look at the physical sciences, there hasn't really been a huge breakthrough in the last, since the turn of the century. So are there breakthroughs to be made, and is AI able to do them? Is it AI more than just a regurgitation of data, and can it create something actually new? It's already done it in certain games, where I talked about chess earlier, or Go, where it's made a move that no human has ever seen, or it's made it, whether it's on chess or Go, and it almost doesn't make sense from a human perspective. Is that going to happen with something like science? It remains to be seen. And I think that would be the next huge breakthrough that just takes the human race to an unbelievable, next level. So, I mean, is that going to happen in 10 years? I have no idea, but that would be pretty exciting to us.
Yeah, I'm reminded of a book I just finished on the story of ASML and building these lithography machines. They're just, these are some of the most complex machines on earth, and, no person understands how they work, but I think eventually AI is going to help them figure out how to continue Moore's law and, think in ways that humans just can't possibly even imagine.
Yeah, just some of those advances on those techniques are unbelievable. Just the getting down to 1 nanometer or something. It's crazy. That level of technological advancement in that arena has been so impressive. So, yeah, if AI can help us there, I'm just very excited to see it.
All right, Deiya. Well, thanks so much for joining me here. I've really enjoyed this chat and appreciate you sharing with our audience a bunch of the research you've done as of late. Before I let you go, how can the listeners get in touch with you and learn more about your work?
Yeah, very happy to be here too. Thank you very much for the discussion. Anybody that wants to learn more about our business, visit us at pernasresearch.com. We produce actionable stock research for professional investors and RAs. So anybody that wants to take a look, that's where to go.
Excellent. Well, thanks again, Deiya. I really appreciate it.
Thanks.
Remitly is one of the fastest growing companies in the payment space, but the big opportunity lies in the fact that it's not priced for that growth at all. It's kind of like an early Uber. The business has tremendous potential, but current expenses to increase scale and reach still cover up the underlying earnings power.
We are just now hitting the inflection point though. Remitly is already free cash flow positive, and if we look at it at a steady state valuation, the business is profitable across the board.
And those inflection points tend to be when the market wakes up to the potential of a company, and therefore also its stock, and the returns are huge.